Welcome, everyone. We'll just wait for all the attendees to join. We'll give it a minute or so, and then we'll start the webinar. Welcome, everyone. We'll just wait another 30, 40 seconds, and then we'll start the webinar. And really great to say where you're dialing in from. So welcome, everyone. We've got people from Australia, Texas, Canada joining, Minnesota. Welcome. Isle of Wight, welcome. Dubai, South Carolina, Puerto Rico, fantastic.
Finland, Slovakia, awesome.
A truly global short-term rental industry, Pembrokeshire. So welcome, everyone. We'll still wait because there's still more coming in from the waiting room. And then I will introduce the speakers and we'll kick off. Someone's just put a comment, is this really live? Yes, it is really live. Tuscany, Spain, Edinburgh, Malaga, Miami Beach, okay, so I'm going to start. I think we've still got more people coming in, but we will make a start. Welcome, everyone, to Hostaway's Trends Predictions webinar for 2023. This is a really exciting panel that we have here with real leaders in the short-term rental space, and I'm looking forward to moderate it. And before I ask all the panelists to introduce themselves, I'm just going to do a few housekeeping things. This recording will go in an email tomorrow, so if you do have to dash off, you will get the recording. It will also be posted on YouTube, and we really welcome participation from the audience. So if you have any specific questions that you want to ask, do put it in the Q&A. If you put it in the chat, I will also notice that, but if you put it in the Q&A, we can answer it, and we'll make sure that this is a really dynamic conversation. And I am really delighted to have these 5 gentlemen here talking about the short-term rental predictions and trends. It is going to be a really dynamic panel. I know I've got my work cut out for me, keeping control of it and keeping it all keeping going. But I'm really excited to moderate this, and I'm going to ask you all to introduce yourselves. So Marcus, thank you firstly for hosting this, and Hostaway for hosting this. And if you could do a quick introduction, that would be fantastic.
Absolutely. So welcome again, everyone. My name is Marcus from Hostaway. We're a vacation rental software provider, and 2022 was really our year. We represent thousands of property managers and property owners with over 100,000 properties, and we got customers in almost every country of the world where vacation rentals are a thing. So I'm very excited about this discussion today.
Great, thank you, Marcus. And Andrew, I'm going to come to you next.
Hi all, I'm Andrew from Wheelhouse. We build pricing and revenue management software. Excited to spend time with you all today.
Thank you, Andrew. We've just got a props on the shirt, Marcus. Very cool, which I always think about that shirt. And Jeremy, your turn.
Thanks, Jessica. Thanks, Marcus and Hostaway for having us here today. I'm Jeremy Gall. I'm the founder and CEO of Breezeway. We're a property operations and hospitality experience platform, helping people make sure that they're taking care of their properties and doing all the hard work of being a professional host and manager.
Great, thank you. And Simon.
Thank you, Jessica. Thank you, Marcus and Hostaway for having us. First and foremost, for the first week of the year, I wish everybody a happy new year and lots of success and health for the coming 2023. AGL Atelier is an advisory firm, a global vacation rental advisory firm, and we consult any stakeholder within the property management industry, from investors all the way to property managers and technology companies. And I'm super excited to be here today.
Thank you. And Steve.
Hi, everyone. I'm Steve Milo. I'm the founder and CEO of Vtrips. We have 7,000 properties under management in North America and about 800 employees.
Great, thank you. So welcome all of you. And before we begin, I'll probably interrupt you a little bit if you overtalk, so just kind of warning you on that. And also, just for the audience, really encourage you to ask questions and engage in the chat. Be really good to get your perspectives on predictions and also what you're seeing in your short-term rental business. So to begin, Andrew, I'm going to ask you, I think let's start with a money question and let's look at ADR occupancy. What's it going to look like for 2023?
Yeah, I think whenever talking to a truly international group like this, it's hard to have one specific ADR occupancy answer. I think in general, though, the conditions are pretty perfect for 2023 being quite a bit of a harder year than 2022 and 2021. That's supply growth, weakened discretionary spending. So especially US and Europe are Europe in particular looking pretty recessionary. So I would just say the conditions are perfect kind of in a broad perspective for things for 2023 to be a weaker year. The way we think about this at Wheelhouse, we think the last 2 years, most people have won by driving up rates. We really think a good general strategy for folks as you're starting to see your market develop in 2023 is to focus on occupancy and really to talk to owners about getting more occupancy on the books earlier this year. Again, like when looking at a worldview, that's kind of very general perspective. We think there will be certain markets, certain categories, certain operators that will have a very strong year in 2023. But in general, I do think the conditions are set up to think more aggressively for most property managers about driving occupancy earlier.
We just had a comment from Adrienne who said, what does ADR stand for? And I know that sometimes also there are newer property managers joining these webinars. So I think it'd be really good to have an explanation of that.
Yeah,
please,
I apologize. So there are two main, when you think about revenue, you think about occupancy. So how many nights are you selling? And then the rate at which you sell it at. So ADR stands for average daily rate. And ADR and occupancy are the two main things you want to look at, kind of the levers you push and pull to drive revenue. And they roll up to one more acronym called RevPAR, which is revenue per available room. One of the most important things to be looking at. But ADR is average daily rate. Thank you.
And what else should property managers be watching for this year?
Really pacing, right? So the reason people look at historical data or at competitive data is understand how their property is selling against other properties near them or their historical performance. So pacing allows you to see, is your market booking slower or faster than last year? It allows you to see, is your listing booking slower or faster than other listings nearby? So pacing, which is how many days, a way to think about it is how many days before a stay date is your property selling, really allows you to, in the far future, make an assessment of how your portfolio and your market are doing and to make adjustments before it's too late. And Steve, I mean, this is your book of business. Where would you chime in and add some thoughts there?
Pretty much in agreement with everything you stated. Keep in mind, obviously, we're just in North America. We are not in Europe or the Caribbean or Central America. But we definitely have seen over the past 6 to 8 months a slowdown in occupancy. At the same time, in many of our markets, ADR actually went up. And so, and I think that was one of the weaknesses of, as you call it, being using a pricing software and just kind of put it on autopilot. You need human beings to go in, because if everyone is just scraping and looking at the competition, everyone's ADR is too high, and you really needed to look at nights occupied. To me, that's the number one thing we're looking at, is nights occupied, because if the properties are not occupied enough, we don't generate enough net income for the owners. And I think your pacing thing is spot on as well, because pacing is really what drives your ability to outproduce your competition with net occupancy. So if you're starting to pace behind the market, what you need to do is proactively start to reduce ADR. And I think you talked about a little bit of where that ADR can be dropped, but for us, it's off season and shoulder season for sure are the two areas that you've got to start to really proactively reduce your ADR. And you also talked a little bit about making sure you're communicating with your homeowners, who I believe 95% are sophisticated enough to understand what the difference about net income is, that they would rather just have net income rather than no income.
Thank you. We've actually had a question from the audience from Brett Webster. How many years back should you look for historic revenue? Knowing that the COVID revenues are not realistic for forecasting. Is that something that you can answer, perhaps, Andrew?
I mean, again, it's going to be a little bit dependent on how much your market changed during COVID. There were certainly markets that went down, certainly markets and inventory types that improved. What we don't know yet is how sustainable any of those trends are. Right. So generally, we actually think urban will be relatively strong this year. We think mid-length will stay strong. We think premium will stay strong. I think Steve nailed it. Vacation destinations, in particular in traditional shoulder seasons, will probably see more of a reversion to the mean. But it's very inventory location specific. This is why people use a software platform. Steve's right. That's not just dynamic pricing, but really a revenue management platform.
Great.
I wanted to add there, thanks Andrew for introducing these concepts to us, that for any property managers out there who now are wondering what the ADRs and occupancy rates are, you need to segment these and you need to bucket them. So first of all, it's not about your property, it's about your region, but it can also be segmented by type of property. For example, low and mid, luxury, and you can also find hotel data much easier and cheaper than you can find short-term rental data. And what these tell you are really trends. So they're not necessarily telling you what your property should be doing, but you should rather segment it. And we'll have a discussion later on what you should compare yourself against. From Hostaway's point of view, we identified two things that can impact ADRs and occupancy rates in 2023. There's two trends going on right now, and both of them are related to increased costs. So the first one that's quite interesting is that we have short-term rentals that are switching away to become long-term rentals. And one reason for doing that is that the cost of operating a short-term rental is quite dependent on access and timing of materials if you need to make improvements to make it suitable for short-term rentals, but most importantly, labor costs. If you've had a cleaner who you've been paying $100 per cleaning for many years, and they leave, maybe the replacement costs you $300, and that may be the breaking point where it's no longer profitable to do short-term rentals. We're seeing quite some of that in the market. That's of course good for those who stays because it lowers the supply, but at the same time we're seeing an increase in supply. Also, one driver there is the costs. People who have had their family cottage for many years and never rented it out, the costs are going up. Insurance is going up, interest rates are going up, and once again maintenance is going up. This is a good way to finance those properties, and I think these two will be a defining factor on the supply side and will have an impact on the ADRs in 2023.
But
Thank
back to the base, we're using 2019 and 2022 as baseline years, and indexing in particular properties where we had them in the portfolio for 2019 and 2022. We believe that 2023 is going to come somewhere in the middle between those two in terms of occupancy, drifting towards a little bit higher ADR than 2019. So if you're just looking for data, 2019 and 2022 are your more normalized years.
Love that.
Great, thank you. Let's move on. And, we've had some messages about challenges this year. And, we're walking into recession, economic headwinds, etc. What do you predict for next year, and what can property managers do about it? And actually, Steve, I'm going to start with you on this one.
Well, again, it's region by region. It's somewhat dependent on if you're in resort or urban. I'd say there's a couple different layers. I think if you're dealing with retired baby boomers, you're probably in good shape. So those markets in general, those people have money that's kind of fixed asset, conservative. And I think, I would be very hesitant to start aggressively reducing those ADRs, because those retirees, there's not a lot of properties for them in general. The population is aging. When you get to family stays, that's where, you're going to see some trickiness because of inflation, recession, all the different factors, stock market, that have affected and interest rates that have affected affordability for consumers. And keep in mind that travel is, a discretionary component of this. So people have a decision whether they want to go on vacation. So first and foremost, fly markets are going to suffer much more than drive-in markets, and that's true of Europe and the U.S. So if you're in a fly-in market, you've got to be very, very careful that you don't overshoot the runway with ADR. Second, we've actually seen some pretty significant drops in occupancy on our budget properties. And those are going to have a lot of sensitivity of occupancy, length of stay, and ADR. And you've got to be proactively reducing those budget properties. And those are typically 1 and 2 bedrooms. And then I know Andrew has some competing information, but we have definitely seen luxury start to soften. And we have some data coming from Inspirato, which has done a bunch of leasebacks, and they're aggressively starting to really reduce some of their luxury, just trying to get money in the door. I'd be very, very careful with luxury not to hold on to ADR too long. You need to start to prep your owners. And the last thing is, and it gets tricky because I know people have said, well, we've had a tremendous advanced bookings for 2023. That's probably outlier data. Those consumers who can put money on a credit card and not worry about it that far in advance, those are outliers. You're dealing with people now who definitely could not put money in advance, and your booking window is going to shrink. And you've got to be very, very careful of this whole ADR component, because if you're not and you're too high for the market, your occupancy is going to reduce, and you do not want to be holding inventory at the last minute in this economy.
Thank you. I'd like to get some perspective from Simon actually on this next question. And we're going into a recession, economic headwinds. It's going to be challenging, potentially 2023. And I know that you have vast experience working with lots of different property managers. What is it that you're telling property managers to watch out for this year for operating in those conditions?
Absolutely. First and foremost, I know there's nothing to add from Andrew's and Steve's perception. So I like to take it from another angle, which we have raised in 2019, and that's cost drivers, right? So, Andrew has already alluded to, and also in relation to operating costs, labor costs are going through the roof. You're not able to rehire the same people for the same cost if you lose them. We've seen tremendous labor cost increases. And that's something we need to face. So in terms of revenue and ADRs and what you need to look at, I think there's nothing to add. My angle or our angle is really cost. Truly understand what are your cost drivers, not having anything nice to have, also in terms of your tech stack and how you operate. And I think one of the things we have seen with some of the examples out there, potentially Vacasa, but also Avantstay and others, is that they try to go into 10 markets at the same time. Their OpEx goes through the roof. Their business model is built on single demand channels or very few demand channels. And then all of a sudden, things go out of line because you cannot scale in several markets at the same time and controlling your OpEx. So I think that's something you need to be very careful about, and also looking at potentially de-risking your business in reducing unit count. We're always struggle to actually clean out, or let's call it the forced churn next to the unforced churn. So you also, as a property manager, you can force your churn. Churn is the holy number, and everybody doesn't want to have any forced churn. But we have actually seen quite a number of property managers, especially in the higher end of the market, to say, hey, we want to stick to the quality of the product we deliver. And if certain properties do not live up to that, we're going to force that churn. We're going to tell the owner to leave, number one. And number two, it reduces your complexity for cleaning, for operation, for whatever as well. So I think we need to become very creative while we're doing all the right things on the revenue side, that we also do the right thing on the cost management side as well.
And also the human capital. And I know that you've mentioned before about how important it is to get culture right and your labor force right. And if you've got that right, then the rest does follow.
Yeah, that's one of my new saying in 2023, get the job right, get the culture right. And I think the ones who have been very good to their staff during the tough times in 2020, they're going to be very solid going forward, because they've created loyalty, they've created, people who are very thankful for having been supported. And there's large property management, companies like a Sykes Cottages who have maintained all their staff, even through tough times, and other companies as well. They've managed. And I think they will go a long way, because, this is not a hire and fire industry. While we're lacking professional resources and any type of resources, now it's payback time. If you looked after your people, then they're going to stick around and weather that storm with you again. So I think loyalty, staff motivation, staff retention is absolutely key to maintain quality levels, execution, also in tougher times. And your existing people, they know the business the best, and you don't want to train more because it's distracting and costing you more money. So look after your people now, and you can weather that storm as well.
So I read today that in the US in Q4, there were 1.5 million open positions in hospitality, leisure, and travel, which, says about the scale of the talent crisis. So if we carry on about operating in more challenging times and predictions, advice, what there might be that you could offer to the audience, what would you say? So Marcus, do you have anything to add here?
I actually wanted to hear Jeremy, since you have a lot of operations and a lot of clients who use you for operations. I wanted to hear your point of view here. What are you recommending customers, and what are you hearing on the market?
Yeah, thanks, Marcus. I mean, a couple of things. First, just on this one commentary, I'm an optimist. I think a lot has changed since 2019. I think, trying to book a ski vacation and you look at the supply that's available, it's brutal. Like, despite all the supply gains, when you go and try and look at good supply, like, there's not much that's there. I think, everybody's conversation about managing ADR is correct. Like, let's not be greedy, but I think we'll see. Vacation rentals have been such an interesting category because they can be recession proof. And people will go. People will take that family vacation this year. I think you just have to really manage it carefully when you're thinking about revenue and top line. And I think occupancy is going to come as long as you're not really greedy about it. I'm an optimist that way. On the operational side, I think people are really leaning in. We've been talking about this for a long time. It's about professionalization in the industry, and how you do that. The accidental hosts are just sort of like drifting to the side. Everyone's leaning into tools. I know we're going to talk about technology later, but this is a new phase of growth dominated by quality and professionalism. More exposure from the pandemic. Guests have a real taste for rentals. I think it's just, people are in. I think they're all in, and they're going to be coming back in droves, recession or not. But you do need to manage labor costs, and it's about finding ways to be efficient, still deliver that experience while being efficient in how you do it. And that's what that's what we talk to our customers and clients about. And that's what people, sort of seeking out operational tools. They sort of self-select for that.
I love the accidental host. That there's that phrase and that concept, there's no more room for the accidental host in this industry. And I also read...
sorry, I just wanted to thank you there, Jeremy. This, yes, I completely agree with you. First of all, we are talking about a recession as if it's a fact. I have not seen any GDP go down. That's the definition of a recession. I have not seen any negative GDP numbers at all. And if they go down for more than 2 quarters, talking about a depression, I've not seen that either. Secondly, I think there is, like you're saying, if you want to find a property to stay in, it's really difficult. And part of that reason can be the increased cost and changes in the supply. And yes, there's a lot of room for improvement on the professionalization. But one thing, if we do go into a recession, and that's an if, because so far the numbers are saying the exact opposite. They're saying, in fact, that we are not in a recession. If we do go into one, there's going to be industries that gain and industries that don't gain. A typical example is Walmart, which always has record profits whenever there's a recession. And the question is, where will the chips fall this time around? How will it go for vacation rentals? And I don't think that we're in the same market as we were in 2019. I think there has been a substantial shift when it comes to remote work, when it comes to the working holidays, when it comes to living in different locations. And that shift is entirely different than 2019. How people will prioritize, even if they have a lot smaller budgets or even if they need to save money, that I have no reason to believe that it would be bad for vacation rentals.
Can I add one more thing here, Jessica? I actually don't think my team I'm not in a position to make macro forecasts. It's just hard, and there are bigger forces at work than we really know. I think regardless, if you're in the property management space, or if you're a property manager, and I recognize there are also people just own their properties on this call, but if you're a property manager, what we got 10 minutes ago from Steve was a masterclass in how to speak about what you're seeing. Not from conjecture, but hey, we're seeing this softening here. Here's what we're trying. Here's the data we're looking at, etc. That was a masterclass in how you can use data and look at your portfolio performance to communicate proactively to owners. And that is like, you can't control a recession. You can control your response to a recession. So I would just say, if you get 5 minutes to go back and watch what Steve shared there, you're seeing someone who's speaking to using data, who's probably the best revenue management team in the country, in the US, North America, actually, sharing what he thinks about and how likely, Steve, how you communicate to owners if there are questions, or how you communicate to your team. So that is how you survive a recession if you're in the property management space and you want to keep properties.
Yeah, and it's really interesting, in case this doesn't come up again in this conversation, which it might not. Speaking to owners in 2023, I think is a really important point. Your owners are going to be the ones who are really, stock market's down. It's white collar jobs that have been lost. There's a labor crunch at the bottom of the market. It's some of your wealthy owners with second homes who are sitting there and wondering like what's going to happen this year, who are probably most concerned. And I think that's a trend that people really need to lean into in 2023 is like, how do you really communicate with your owners clearly about what's happening, how their property is being managed, and what they can expect.
Yeah, so Andrew, thank you. I mean, this conversation I've had with all the leadership of my company, which is we need, we've been through recessions before, some mild, some deep. I know what we're doing. We're not going to play games here with ADR and hope and wish that things turn out better. And you're also right, Jeremy, it's about communication. I mean, I literally talked on the phone to one owner who had 22 properties, and he was unhappy that we weren't booking enough during the mid and shoulder season. And, I communicated to him directly that he had tied our hands and he wasn't allowing us to reduce rates. And he was just adamant that rates shouldn't go down. And then a week later, he said, okay, I agree. I listened to everything you said. I did research. I talked to other agencies or, people that had, and you're 100% right. In shoulder season and off season, there's more supply now than demand, and we've got to reduce rates. And you're right. So it is about communication to your employees and to the owners you're trying to protect their investments, and you're better off being straight shooter. Even if you lose them, even if you lose an owner, if you're straight with them and they go across the street to a competitor that's just over-promising, they will be back swiftly.
Keeping on the theme of owners, we've had a question from Laurie Browning. Would you recommend owners put additional money into their property for improvements in 2023? What about Steve? Do you want to answer that one?
Well, yes, now's a good time because there's more contractors available. Back in 2021 and 2022, I think we're all going to be pretty honest. It was hard to find contractors. And we were reluctant to try to get owners to do large jobs because there were supply trade issues and a lot of shortages. But now is the time to, clean up these properties. And we actually took about 50 properties and we sent the owners emails saying they were off program and they would need to go find another rental agency because they were not up to standard. And over half of them came back and said, we want to put money back into the property. So I get 2021 and 2022 were very hard. Now, in most markets we're in, the labor, at least on the trades, has corrected because, housing construction and real estate construction has slowed down so much. And there's the ability now to truly go in and get these places repaired.
Thank you. We've also had another question that I'm going to direct to you, Jeremy, from Steve Eklund. And it comes back to the accidental host bit. What would you, so if we're trying to become more professionally managed versus an accidental operator, what are the most important things to focus on in order to move into a more professional approach?
Okay, a couple of things. I think first, lean into the predictability of the guest experience. As a professional, what are you trying to accomplish? What's your brand, and how are you preparing those properties to meet that brand? Think about safety and compliance at the property. It's about quality and the quality of that experience. Being a professional is about, I think this is maybe a big difference between sort of the accidental host and then becoming more professional, is the engagement with that guest, bringing back repeat guests, thinking about holistically your business and what you're trying to accomplish. That's what more of a professional does, as they sort of think about bringing scale to their business, even if they only have one property or a small number of properties. And then I think it's leaning into technology. You have to lean into technology to drive that predictability and drive some automation. Especially as your portfolio grows, whether it's PMS, revenue, dynamic pricing solutions, there are tools in this industry for you to lean into that help you sort of streamline your business and really compete with. You might not immediately compete with the likes of Steve, but it'll certainly bring you closer.
I read something today that short-term rentals are the gold standard of customer experience with technology, you know, compared to hotels. And I think that, you know, you've touched on that. Now, moving on, we've had a few comments and
Sorry,
questions.
may I just counter there, Jeremy, because I disagree with you here. I don't think technology is the answer to everything, and that's coming from someone who's selling technology in this space. I think there's a lot of accidental hosts out there, people who rent out a place. Maybe they have one or multiple long-term rentals. They convert it into a short-term rental, and it's just not working. And the problem isn't technology. The problem is that they have a preconceived notion of what the guest experience should be like. Maybe they stayed in their place themselves. Maybe they never stayed there. Maybe they stayed in someone else's place. So when the guest arrives, they find out that there's no pressure in the showers. So taking a shower takes 45 minutes. Then they start to cook dinner, and they find out that for 6 guests, there's only 4 plates. And then they go out in the backyard, and all the furniture is destroyed because some bear ate it up last night. These are the things that really give this industry a bad reputation. And what I tell my team, but also every host, is that before you can automate anything, before you can turn it into a process and get the quality assurance in place, technology can help at that point. You need to actually understand on a very basic level what it is you're providing. And in the case of a vacation rental, to test your own experience is very simple. You just go there and stay yourself. You just go into the unit, cook yourself a dinner, and find out, is there anything missing in the kitchen? Because it's very obvious when you have people with 1 or 2 properties that sometimes they have never done that. They have not in their entire lives. Or invite your friends over, sit down on the sofa. See, does your back want to kill you after 15 minutes? In that case, you may want to buy sofa pillows. It's a small investment. It can cost you $20 to buy enough sofa pillows so that your back doesn't kill you. And these are the things that you will figure out as you scale, because if you don't figure out it, you will never scale and you won't need any technology. But you have to go through these really simple basics of what it is to be, what the guests expect.
Let me jump in here, Jeremy. I'll break a leg for you here. The way I understood Jeremy, that's all he said. And he said technology was his last point. So I get that entirely, because he talked about brand, he talked about safety, he talked about quality, he talked about guest engagement. So that's all the stuff that is extremely important before technology comes. And I think we all heartedly agree with you there, Marcus, and that's my record. It has been broken for 5 years since I formed AGL. You know, go and use your properties, and we have no room for crap anymore in this industry, full stop. And if you haven't stayed in there yourself and think this is a home, then don't rent it out. And that is what you want to represent with your brand. And I think that's exactly the points that Jeremy made. And what I liked in Germany's readout is that technology came and automation came at the very end. And then only thing I would have added to that is financial hygiene. And I rest my case.
Yeah, thank you. I think Simon stole what I was going to say, but I think that's great. I'm assuming the bears are put to sleep and the pillows are set up. But I think it's important just to sort of bring it full circle, Marcus, like what happens after you do that? I think there's this fallacy in this industry of, the good looking person who lives right next door to their vacation home, and they walk over in the morning and they make a cup of coffee for the guest that's there. And like, they're always right there to make sure that this experience is just picture perfect on TV. And like, it doesn't work that way. We all know that. Everybody who's in this industry knows that like the owners live thousands of miles away from their second homes. They're being managed by someone else. Or if you only have one property and you're trying to lean in, or 2 properties, someone is there locally trying to help you. And after you've done that stay yourself, you have to find a way to lean in to make that experience again and again the same thing, because that's what it takes to be a professional. That's what it takes to deliver a hospitality experience. And in 2023, there's just no more room for people who aren't going to do it that way. That's the only thing I mean by accidental. Everybody here, Steve's accidental. If I remember correctly, I mean, Steve, you started with one property. I mean, Steve is an accidental manager at the beginning. Everybody's here by accident, kind of. But the fact is, like, afterwards, then you sort of grow up. You put your big boy clothes on and you sort of go.
Thank you. I'd like to move on now to what regions, types of listings that you think might do better this year. And we've had a few questions or comments from the audience. So one question from Carolina Corville is, what about the Latin American market? What do you predict for that next year? And then we've also had a question from Sandra Cahill, asking about corporate group bookings and retreat style properties. Adding on to that, what do you think about, you have talked a little bit about luxury, and I know that there's differences in opinion on how luxury will be next year, but also, cities compared to the leisure market, business travel as well. I know that, business travel has had a huge amount of investment compared to consumer travel this last year. So if we could start to look at, and Marcus, I'm going to start with you here, what regions, listing types, somebody else has asked, what about novelty listings? Do you think will fare well, and what will not fare well?
So assuming that we are heading into a recession, of which I'm not convinced, but let's play the game and assume that things are going to look worse. At least we can agree on that. There will be, so the biggest growth that we'll see will be in what I would almost call secondary markets. So there's a couple of trends here. First of all, in the last 2-3 years, a record number of people have packed their bags and moved somewhere else. So for example, in Florida, which is one of the biggest markets in US, investors are being outbid by people who want to buy a home to live in, which is quite rare. If you look at the last 20 years, we've had the exact opposite. So that's one thing that has impacted the supply and demand. And at the same time, digital nomads that have been around for about 10-15 years, they're getting outbid by the new generation of digital nomads that we know as remote workers. So all the locations that the digital nomads used to go in Mexico, for example, or the big cities in Brazil, they're going to be outbid from there. But there's going to be smaller areas where those go instead, and that's where we're going to see the biggest growth. So the biggest growth will be seen in smaller areas where people can live and work remotely, but have that we don't know the names of those areas because they're never in the news. But they are going to see the biggest demand spikes, and we're seeing a lot of smaller cities in Mexico absolutely booming right now because of this very phenomenon. People who used to go to Florida, they can't because there's no properties available because everyone bought them and lived there. So they started going to the big cities in Mexico until the pandemic happened. And then all of a sudden they have to go to the small cities in Mexico that are now having an unprecedented boom. Same thing for smaller areas in Europe. For example, the south coast of Spain is doing really well.
Thank you, Marcus. Can I bring you, Andrew, into this? And what types of listings, regions you think that will fare better this year or fare well this year?
Yeah, look, I think again, we do a lot of pricing revenue management software. That's what we do. I still would tell you my macro projections are not something I would go invest upon. Generally, I think larger inventory is certainly here to stay. So folks who can squeeze in an extra bedroom or extra sleeps, that seems to be quite profitable. In terms of, again, which regions or areas, you really need to go look at your market. You need to go look at your inventory and comp set to understand what performance is going to look like. That's just the blunt truth. You need data tools. Now, from a different angle, because a lot of the folks on this call, probably the property you have or the properties you have are going to be the properties like what you have now, you'll probably have roughly at the end of the year. So a way to think about it also is like, well, how can you change that property to take advantage of trends? And on that front, I think it's actually kind of a different angle. So for example, during COVID, your pet policy became very important. More travelers were staying for longer stretches of time. And when people stay for longer stretches of time, the notion of leaving the dog at the vet for a week or 2 weeks, well, that becomes a really expensive proposition, right? And similarly, people who stay for longer, they're probably going to need more of a workspace. So a question you could think about for your properties, excluding expansion of your portfolio, but how you can optimize your portfolio is look into what people are doing in your area. So for example, people are like electric chargers might become increasingly important. And that's something you can filter by on some sites now, meaning all of a sudden you might be the only home with an electric charger. It's like, guess what? Every single person with an electric car is going to book your place first. So I wouldn't almost even think about like regions, et cetera, all the data's there. The next kind of slice of dice of the data is look at your properties. What amenities are you offering? And what are people looking for when they come to stay in your location? So I'll deflect a little bit, Jessica, because again, that's just such a specific question that has to be answered with data. It's hard to give general advice, but I do know that anyone can look at the amenity profile of what's booking and potentially rejigger their homes.
I'll give out one investor tip. There's an opportunity to buy commercial properties. The right commercial property can be taken into residential. And I'm in the midst of converting 2 commercial properties into residential. And there's a much higher cap rate on residential and multifamily right now. So if you're looking for an overall strategy, the commercial market is soft, very soft in certain areas. And you might be able to take those buildings and turn them into residential or multifamily.
Thank you. This brings us very neatly into the next topic I'd like us to look at, which is the flexible living, the convergence of inventory types. And firstly, there is that creativity that you're talking about, Steve, but also, we're seeing hotels going into, we've seen this for a while, but hotels going into short-term rentals, vacation rentals, also multifamily. And Simon, I'd like you to start here, please, and tell us about what you predict for the convergence of lodging in 2023.
Absolutely. Thank you, Jessica. 2008, when one of the large OTAs added vacation rental to their distribution, we talked about convergence. But what happened then was more bringing 2 types of supplies together onto one platform, which means the customer converted from hotels. There was a convergence from hotel customers into vacation rental customers. So now 15 years fast forward, now finally the inventory is converging too. Before there was very distinct between hotels, STR, long-term, and serviced apartments or corporate housing. And I think these lines are getting substantially more blurry in 2023. And that's definitely one of the predictions and trends that I see on a higher level for this year, next to many others, is that we will see more of that convergence happening. Marcus made a point before that more units are going long-term. I believe it goes in all directions, long-term into short-term, short-term into long-term, and then adding the hospitality-like feel to it, larger rooms with a kitchenette instead. The hotels have understood that now the customer that we have finally converted during COVID is now a different customer because he's been educated and he doesn't want to sit in a 2 square meter room anymore. Well, he had the comfort of STR. So I think all that will drive this convergence. And then the other point that Steve obviously made in terms of cap rate from a commercial market as well is that the flexible is all of a sudden a new asset class. Flexible living, you can sell, you can rent, you can sublease, all the stuff that we haven't even wanted to talk about at large corporate housing conferences about STR. That was the devil. That was the evil of this industry. It was all dangerous and you can't let your tenants to sublet and all this. All of a sudden, we will see that. And I think ultimately what this means is that this is a massive opportunity for vacation rental property managers, because still today between multifamily and short-term rentals, it's still a 2 different breed of the type of property managers who touch this stuff. And I think the short-term rental guys have shown the stamina, the flexibility, the innovation to actually crack the multifamily space as well, and to say, hey, we can do multifamily, midterm, long-term, short-term, whatever it is, we will take care of that. We have the distribution platforms. We have the technology for it to support it. We don't just need to clean the staircase once a week. It's a lot more in it, right? So this is super exciting. And I think, so on the investment side, on the consumer front, will all drive the convergence of supply as well. And it's going to be, that's new opportunities for property managers. And we've seen it, a lot of property managers have lost a lot of inventory during COVID into long-term. Then they thought, hey, I don't want to lose this asset. So I offered my property owners to look after them as well while they're in long term. And then when they come back, I can still look after them. So I think it's going full cycle. And therefore, for all these reasons, I see supply really going to converge.
Thank you. Andrew,
Yeah.
would love to hear your thoughts here.
Well, I totally agree with Simon. And there's Skift has kind of called something the great convergence, which is they usually talk about the convergence of a hotel and rentals. I think of the all caps great convergence, which is the convergence of residential real estate and accommodations. And all of a sudden, much like Simon's speaking to, you could take a multifamily building and you could have some of it long, medium, short, and that inventory could flex throughout the year. And I think it's really interesting. When you look back for the last couple of years, usually in 2022 and prior, you were seeing fundraisers from, tech companies or property management companies that were publicly announcing fundraisers. What isn't publicly announced is when Starwood or one of the major real estate companies decides to move 1,000 listings from the long-term market over to a mid-length. And that is not really reported, right? But the largest portfolios out there are deciding that this great convergence of, or maybe the opportunity to offer kind of a different type of inventory to folks, that mid-length or shorter length, is very interesting or necessary at certain assets. So I think there's so much interesting stuff. And I think the last point that I think Simon hit right on the head is for short-term rentals, there's been a lower barrier to entry, meaning we can work with a person who has 1 listing or 10 listings or 100 listings, and we can iterate really quickly around their needs. Meaning if you're an entrepreneur right now, it's like, well, I'm going to start a technology company for short-term rentals, knowing that I can get paying customers more quickly than going to try to win a hotel. So therefore, the pace of iteration in our space, I would argue, is faster. The technology, I think in some ways is better. In some ways, we still have a lot to learn from the residential and the hotel side, but I think the pieces are there for short-term rental technology to impact the design and the implementation of technology for the entire property sector.
I'd like to add here, Keith commented that we sound like a bunch of guys from Wall Street, and it's not really useful. So I'll try to give something useful here. I would rather than looking at the types of inventory, look at the types of guests, because this is something that there's a clear divergence in the market. When you go out looking at properties, there are those who have figured out exactly who should stay there. And a good example, Steve mentioned here early, family vacations. It's very obvious when you look at the ad of a certain property that this is meant for families to have for vacation. But then most of the new property managers and people who enter the market, they advertise, rather than advertising the customer, they advertise the property itself. So they call it something along the lines of beautiful bungalow, and which doesn't mean anything. They don't call it the best place for a family vacation. Now, the challenge with that is that the people who are booking right now are extremely diversified. And of course, if you're only offering a family vacation home, you're only going to get families booking it. But that's a very small segment of the market. There's a much bigger divergence in people staying longer, people traveling with groups of friends, people working remotely, even a good example, workers, construction workers who need to be in a place, or people visiting their friend's wedding. Now, your property, if you want to advertise this widely, it needs to fit all those needs, because the expectations of, let's say, a construction worker who wants to work 14 hours a day and then go to a restaurant, pick up a meal and go straight to bed and wake up at 6 a.m., take a shower, their needs for a property are entirely different. For one example, they don't need a kitchen. Whereas if you got someone who's working remotely for a month, they will need a kitchen at least 2, maybe 3 times a day. And my advice here to the property managers is is when you have an idea of the ideal guest profile, have a look at your property and think who else could stay there, and then go and make sure that the property fits that, because that's going to be crucial for being successful in 2023.
Thank you. We're coming up to the hour, and I know we can extend this webinar, so we will do that. But the next topic I'd like us to look at is tech consolidation. And I'm actually going to start with you, Marcus, here. What do you predict? It's often talked about, in the industry, but what do you see as being the truth here?
So this is relevant for property managers that are working with technology, and there's been a lot of consolidation in the past years, and not all of it has been good. It could mean that your business is relying on a software that suddenly stops improving, or maybe a software that suddenly improves a lot, and a software that might increase the prices. Now, 2022 and 21 were record years for this. This has been quite exciting to see, and now we're seeing a very interesting divergence. This is not only vacation rental, but all technology businesses, where unprofitable businesses who need fundraising to survive, they're having trouble. But at the same time, we're seeing that there is a massive need for consolidation. Just like on the property management side, there's too many accidental hosts out there who don't know what they're doing. There's too many technology providers, and some of them provide really valuable things but aren't able to market it in the right ways. This is why this consolidation will continue in 2023. I'm sure Simon has his views as well.
I think Andrew does, and I would love to hear from Jeremy as well on this one. Who wants to go first? Andrew, you got some points here?
Why don't Jeremy hit a bud? I'll follow up.
Okay, I'll go. It's a complex business. Tech consolidation, there'll be consolidation, but this is a tough business. You're supposed to be good at a lot of things, and I think it's complicated. And I also think we're just hearing it here, and I guess maybe we do sound like bankers or that's an insult in my book.
It's an honor. No.
Yeah, an honor to some, an insult to me. I would say, like, hey, look, you can hear it just in this conversation, the way different people, all of these trends we're talking about, they're different per location. They're going to have different effects on you as an operator. There are people from all over the world here in diverse markets. We're talking about flexible living, multifamily coming in and converging with short-term rentals as well. We all operate in very different ways. How you operate, even if you're a really large manager, Vacasa operates much different than the way that Steve operates. Steve would be the first one to tell you that. And so you need technology and tools that can be responsive to that. And to think that one monolithic tool is going to hit all of those different unique points is outrageous. There will be tech consolidation. PMS companies will gobble up other PMS companies. They will gobble up ancillary services. You do need to pay attention to who your vendors are, what their strengths are. But the idea that this whole industry will be dominated by like 2 or 3 players, I think is not going to happen.
I agree with Jeremy. I think Simon and I are both working on market maps. I see at least 19 different categories of software, and that's being conservative and kind of lumping a bunch of softwares together. I think there's so much more software to come into space. Marcus, you mentioned, what if you open the cupboard and there's 4 plates? Is there good software to track what's known as furniture, fixtures, and equipment, or operating supplies and equipment for places? That's starting to happen. In hotels, they have that dialed, right? Like the reordering of supplies. There's all these things that we didn't really think of. Like 10 years ago, people weren't really looking for technology solutions. And now, whether you're underwriting a property, whether you're trying to manage your remote or your field ops team, whether you're trying to automate guest communications or do ancillary and upsell, there are whole categories of software that are essentially unexplored and underdeveloped. And I think you want 20 different competitive tons of teams competing to build software of depth. And I think consolidation will be a sign of weakness as opposed to a sign of strength.
I would
Simon.
argue it's a matter of definition what consolidation means. And obviously, I agree with both of you, Andrew and Jeremy. There's not going to be a Microsoft or an Apple OS out there in our industry sure to come. I'm absolutely convinced of that, and I totally agree. I think we also need to understand, we're definitely going to see a slowdown. One thing we haven't really talked about is capital. Marcus made a couple of comments about it. I mean, you don't want to go out and fundraise right now. Good luck to you. That's going to be tough as nails. And we talk about PMCs, but we also talk about technology companies. So I think we're going to see a slowdown of innovation. We're going to see a massive slowdown in VC capital coming into this technology market. The ones who are established and show good track record, route to profitability, etc., are in a better spot. But anything below that in terms of acquisition and growth is going to be super tough to raise capital. So that will slow down the innovation, which will sort of push the consolidation forward, arguably. And the same thing is happening on the property management side. It's going to be very tough to raise capital. First of all, because of the VC markets, and secondly, the showcases out there really haven't proven a lot of return in capital that we've seen out there for investments that have been made with hundreds of millions, and obviously the returns are far away from promising, and therefore this is not good for us. So I think that we could argue that there's also a certain amount of consolidation. Is there enough space for 40 tech verticals, Andrew? My answer is clearly no, and I would not debate with you. There's not more than 40 tech verticals. Looking at the landscape right now, we're in the process of doing so, but that is extremely challenging, and I think we will see. My argument is you can't solve one of 50 things and survive in this space. While we're now talking about ADR softening potentially, our income might come down, our margins might come down. You're not going to add margin to your tech cost to your tech stack, because that's not going to help to improve your margin over time. Arguably, depending on revenue management, certain things will help you to create efficiency operation software, etc. But there's a lot of software out there that you simply don't need to run your business on a day-to-day basis. And therefore, all these will potentially play against each other and rather slow it down, but not consolidating it down to 2 or 3 players, I would agree.
Thank you. Moving on, I'd like us to talk about marketing and OTAs, and what would you like to see coming up in 2023? And I'm going to start with Steve here. I read an article that you wrote on LinkedIn, I think it was last week, where you talked about wanting to see booking penetrate the US greater than it currently does. But I know you've got lots of thoughts here. So do you want to kick us off?
Sure. Well, I would say anyone using a channel manager has experienced a lot of pain. And I think the channel managers that we've worked with have not provided a good experience to us or to our guests. And I recognize that in some cases they're a bridge, but I specifically requested a meeting over at the Click conference in Nashville with Glenn Fogel, in part to make sure he understood that in order to have Booking.com penetrate the US market, they needed to have direct integration. And that was a conversation because it was an unbudgeted expense. That integration conversations with Booking.com got put on hold during COVID. So and it looks like TNS is going to have an integration with Booking.com, and I will be happy to get rid of the channel manager we're using because their performance has lagged so much. The big issue right now is anytime you're using a channel manager, you are essentially having someone go in and hard code your information and essentially try to cheat through the process of pushing that over to an OTA, and that is just a bad process. And and using at least 5 or 6 of them, the experience is miserable. They don't update their content. They tend to run from fire to fire. They only start to work on new properties when you threaten to fire them. Just a really bad business model, and it's just been a lack of really I guess they can't scale the stuff. But I'm looking forward to when we never have to use channel managers.
Well, that time is here, Steve. It's they're gone. I actually call it the death of the channel manager. All-in-one solutions that allow you to manage the business and directly connect to all OTAs. That's the way we go. And it wasn't certain a few years ago, but this year has shown us that exactly the problems that you described, they don't work. And we made a very bold decision about 7 years ago that we're never going to use an external channel manager. We're going to build our direct integrations, and we even had to wait 4 years for Airbnb to allow us to do that. But it was worth the wait because the time is here. I'm sorry you had bad experiences with channel managers, but direct integrations, going for all-in-one solutions, is the way to go.
So Marcus, I have a question for you. Expedia, who owns Vrbo, when are we going to have a direct integration with Expedia? Because right now we have a direct integration with VRBO, but not Expedia, which is partly why their performance has been horrendous in the North American market. I mean, they have so underperformed in the US market. They should be embarrassed. I guess they're not, because there's been so much leadership turnover. But I mean, it's a debacle how bad Expedia has performed.
That's a good question. So at Hostaway, we have a direct connection with both Expedia and Vrbo, and this is relevant to everyone out there who is either using Expedia or considering using them. So while they own Vrbo, these two companies operate as separate entities, and the type of properties that they have is very, very distinct. If you got a hotel, you cannot sign up for Vrbo. Even if you try, you're going to be directed to Expedia. If you have a vacation rental, or if you have 7,000 of them, you cannot sign up for Expedia. Even if you go to Expedia and sign up, you're going to be directed to Vrbo. However, there is a divergence there. If you got corporate stays, if you got apart hotels, if you got multi-unit buildings, then those can be very suitable for both platforms. And there is also some sharing of data between those platforms. So you might be advertising, but this is why, because we have customers that are on Expedia and not on Vrbo, and they're doing really well. We also have customers that are using both, and of course, a lot of customers are only on Vrbo. So this is maybe the reason they're trying to move to a direction where one type of inventory is on Expedia and a different one on Vrbo.
Simon?
Yeah, I would like to take the conversation back to your original feedback from Steve as well, where he's obviously supporting Booking.com to arrive in the United States. I think a clear differentiation between the US and Europe is multi-channel distribution, right? I mean, the US is crazy enough to have property managers who build their business on one demand channel. You see very few of those in Europe. You can trust me on that. Because people have been around for far longer than the company in San Francisco has, and therefore we know what distribution means. And the legacy operator, the older operators out there like Anova Solar Ways, Cottages.com, Sykes, Interhome, these guys are still above 60% direct distribution, just to keep things straight here. And they've used OTAs to balance their demand model, and their cost of acquisition, et cetera, et cetera. The US, it's been opposite. And what we have seen, anybody who's tried to enter the US market couldn't crack it. We've seen Hollydo go there, they build up an operation, couldn't make it. People did not understand what a meta platform is. And I'm not saying this is the ideal world. Booking.com has not succeeded in the United States either. It's been extremely tough for any OTA to make inroads into the market because people are still comfortable enough, I would argue, and I've been on the board of Vrbo, to say, hey, this is good enough for me, right? And I don't think over time this is going to be good enough. And I'm glad to hear that also from Steve, who's always been very critical about OTAs, to say, hey, we need to have alternatives in the way we distribute. Let us remember March 2020, when everybody, all the guests were refunded, but the hosts weren't. We've all forgotten about it. We have so short memories, right? We've all forgotten about it. And now we're going straight down the same rabbit hole again, while we're not seeing opportunities with other potential distribution platforms that that could give us a possibility to sort of leverage and balance out our risk in the way we create demand.
What about direct bookings? Marcus, I know you were quoted in FocusWire yesterday, and partially that was around direct bookings. What do you predict for next year?
I think that's completely so. The reason direct bookings have become so popular is the lack of supply. Was it Jeremy who said you tried to book a ski holiday and it's very difficult? Direct bookings give much more flexibility, the ability to pick up the phone and ask, do you have a place like this suitable for my needs, is something that no OTA today can provide, but that's something that every property manager can provide. And they have a very strong financial incentive to do so. I think direct bookings will continue to be really strong unless you can actually go on an OTA and find 1 million properties that are exactly what you need at the price point you're willing to pay. We haven't seen that in at least since 2019, but if that happens, I think direct booking will take a fall. Personally, I don't think that will happen. I think we will have supply constraints all the way through 2023 as well.
I can tell you, from a larger company standpoint, we spent a lot of time in 2022 talking about how to drive more direct bookings. And contrary to some other large property managers, we're getting 60% of our bookings direct. And we've worked hard to get there. But, what we've been very clear about is, it was too easy in 2021. I mean, we had some companies we acquired who stopped doing email marketing. That makes no sense, right? If you have more demand than supply, raise prices. Don't stop demand. But at any rate, we're making sure we've got the marketing team totally focused on email marketing, trigger campaigns, social media to the extent that pays off, and pay per click, particularly on struggling properties. And we've spent a lot of time on our direct website focusing in on conversion challenges and really looking at the Google Analytics. And unfortunately for some who are listening to this conversation, it may be too late. I mean, you're going to have a tough time in 2023. I'm not a banker here either. I started with one property. I've been through multiple recessions. This is going to be a tough environment. And if you're totally dependent on OTAs, you're in deep trouble. I mean, you need, maybe this will be a wake-up call, and if you're small enough, you survive this, but you've got to have your own website. It starts there. And once you have your own website, you need to be collecting emails of every guest, including those Airbnb guests. You can get their emails. And you need to have a contact strategy, a rebooking strategy. I mean, hell, we do outbound calls to guests. Before they leave, we ask them if they want to rebook a year from now. I mean, these are all basic things that you can do, but those are the basic things that people stopped doing when it was so easy in 2021, when they had more demand than supply. But now it's not easy. And it's up to management and leadership, which the people on this call, we're all leaders, and we have staff that looks up to us, and you have to basically say, look, this is what we have to do. We're going to have to be better. And I don't care if our competition's not sending out emails. That's too bad. We're going to do it. We're going to do outbound calls. Everybody in the organization is going to do outbound calls because that's critical.
You've just given us the playbook, Steve. The property managers, the playbook on how to be successful with their direct bookings. That's such, wealthy information there.
Can I just add to that? I love that because they're kind of distribution channels and networks, right? There are operators who have hundreds of thousands of followers on social media platforms, including TikTok, et cetera, which are demand channels now. So there's a marketing side of this business that Steve was just speaking to with emails, but any social channel could be a new channel for discovery. And I think really thoughtful property managers and owners are recognizing, yes, you can sell on the channels, but all of those social media instances of your business could drive people to your direct website and your direct booking site. And that's again, when you look about what are the technologies that could drive your business forward, like you probably use a lot of them just in your own personal life. And can you use them for your business as well?
I think also to add to it is it's so much work goes into the direct bookings. You know, there's a mix of marketing channels that you're using, and you know, it's not just, oh, I'm going to send an email out here and there. It's consistent campaigns.
Well, like all things in life and especially in work, you can't just do something and expect good results right away. You can make it easy to do it the first time, but what you really need to do is to keep repeating it, and eventually it starts paying off. I'm pretty sure when Steve sent his first email, he got exactly 0 bookings, but then he sent another 10 emails, and eventually he got the first booking. That's how everything in business works.
Good. So we're coming up to the time to wrap up now, and to end it, what I'd like all of you, I'm going to ask you all, if you had to bet money on one prediction that would come true for 2023, just the one, what would be the prediction that you'd bet your house on, that you'd be willing and brave enough to share with us? And who would like to go first for a prediction of what you think we'll see in 2023? Simon, you're going to be brave. You're going to go first. Put the house on the
I'm going to go
line.
first because that's one topic we haven't talked about, and it's very close to my heart. And the fact is that global warming can't be stopped in 23, and that's something I will put money on today.
Thank you. Next, Andrew, do you want to go next?
I love Simon's. First of all, thanks for that nod. I think the recession, economies go like this, travel trends go like this, technology moves one direction. I think teams that invest in technology and continue to learn their technology to put it to use will ultimately win. Ignore the noise, focus on building a long-term sustainable business through scalable operations and tech.
Thank you. Jeremy?
I think we will see increased regulatory activity across the entire landscape, probably changing from property use and a little more leaning in towards property safety. I think we're seeing a lot of safety concerns being raised, and I think we'll see the industry lean in as part of this emphasis on quality. The OTAs and everybody else, we got all the properties on. Now it's about making sure the quality properties bubble up to the top. That's what everybody's concerned about, and I think we'll see more regulation in that front in 2023.
Thank you. Marcus?
All right. First of all, thanks everyone on the chat who are recommending and happy with Hostaway as a way to create your direct booking site. It's heartwarming to see your feedback. About the one prediction that I'm willing to bet my house on for 2023. We are going to enter the roaring 20s. We did it about 100 years ago and it didn't end quite well. But we're going to see that this year, and it's going to start around summer. What will happen is inflation will slowly fizzle out. Last 3 months, inflation has been around 0.2% in the US. And the interest rates will stay high, sticky for a long time. It will take a few years to go down, but by the summer we will see a rapid shift. There is just too much capital available on the markets right now. Higher interest rates are not removing that capital. When you put money on a bank account and you get interest rate, you get more money. So the problem of having too much money in the world is not going to go away just because interest rates are going up. In fact, it's gonna be multiplied. If the interest rate is 5%, we're going to see 5% more money. That money is looking for a home, and that home we're going to see next year is going to be real estate. It's going to be stock markets, maybe crypto. It can be anything where money is looking to find a home. I'm not at all convinced that we're going to see a downturn. In fact, I think the next 7 years will be quite the upturn in the economy overall.
Thank you. And Steve?
I was glad to hear some optimism from Marcus. I talked to a lot of investment bankers, and the capital markets are pretty shut down right now. But let's hope that they open up by the end of 2023. You can bet your house that unfair regulations are going to continue throughout the world, and more cities and towns are going to be zoned out. And unfortunately, this is a topic that, probably a separate webinar could discuss. There's a lot of movement on this, finally, with property managers getting organized, but it's going to take a lot more companies and stakeholders to, in the US and in Europe, to organize our efforts. It's a huge issue. It's not going away. It's actually been exacerbated by Airbnb, who just seems hell-bent on zoning stuff out because they're allowing properties where they shouldn't, and that's creating all the friction with affordable housing, which has really been a reaction to people being put into areas where they shouldn't, and the shared housing is also exacerbating this. So, Airbnb has not done the industry any favors, and it starts at the top of Airbnb. I wish he would exit the company, and maybe the shareholders at some point will ask him to exit like they did with at Uber. But right now, the biggest problem we have is zoning out properties. And I think investors, if they're one thing they should do is diversify your holdings out of one area, because when you get zoned out, you are screwed.
Thank you. And thank you, all of you, for all your insights and sharing all your knowledge. It's been a really great panel. There's been some really fantastic comments in the chat. And thank you to the audience for coming and listening. This recording will go on, be sent by email tomorrow. So if you've registered, you will get the recording. It will also be on the Hostaway YouTube channel. And a big, massive thank you to Marcus and the Hostaway team for putting this on. It's been really fantastic. You always do such great webinars. And I know that you're also launching a podcast coming up soon, which I, for one, are excited to see that come to fruition. And thank you, Steve, Andrew, Jeremy, Simon, also for all your great insight and giving your time for this webinar. And I know that if any of the audience want to get hold of you, they can connect with you on LinkedIn. And I think also, Marcus, that you probably need to share where you got your t-shirt from, because we've had loads of comments on your t-shirt. So perhaps you could just, share that as well, where you get where anyone can get your lovely t-shirt.
I'm quite surprised, considering the extensive knowledge we have on this panel, that one of the most popular questions is about my "And Justice for All" t-shirt with the Hostaway logo. There is hope for you all. You can go to hostaway.com, click on careers, and apply for a job. But that's not good enough. You have to be one of the best performers once you get the job. But I certainly hope you all apply for a job at Hostaway.
Great. Thank you. So thank you, everyone, and have great days, evenings, wherever you are in the world.
Thank you.
Thanks all. Thanks, Jessica.
Thank you, Jessica.